executive summary. Let me give the executive summary like this. Iwasu Super Rice Company Limited is a proposed rice milling and processing company seeking 150 billion in initial capital to establish operation in Gasimbo District, Eastern Province, led by MS Ngabire, an agri-business master's holder with extensive skills. The company aimed to provide super quality rice at affordable price to a diverse market, including restaurants. Remember, we are given the market target: schools, supermarket distributors, and individuals. The company projects strong revenue growth over 5 years and a quick break-even point, differentiating itself through eco-friendly packaging, online sale and delivery services. If you look at that, it summarizes almost everything that we'll be discussing. That is why we call it an executive summary. It summarizes everything. It highlights almost everything. The profitability, the edge that the company has, who leads the company. It is a newly established company, an executive summary. Now let's go to the company description. We give a description of the company. The company name is Iwasu Super Rice Company Limited. Product name is Iwasu Super Rice. Remember, we've seen that. Where is it located? Gasimbo District, Eastern Province. What is its mission? To provide customer with the super quality rice at a reasonable and affordable price. What is its legal structure? What is its management? One, it is a private company. Remember, we are not told about listing. It is a private company, but remember the first one was a listed company. The one we are writing the business plan is a private company. That is with MS Ngabire and other investors holding shares in a private company. How is the ownership structure? MS Ngabire will take 65% and the other investors will take 35%. It is clearly stated in the question. How is the management? It will include managing director, the finance director, operation director, HR, and overseeing 25 employees. The board of directors, 9 experienced members from diverse fields. It is about the structure of the company from what we have. Now, how are we going to analyze the market? The market analysis. Target market is restaurant, schools, supermarket, distributors, low income and medium income individuals. This broad target indicates a large potential customer base. Now you have started preparing the bank that we have a market. We have a market. If you give us money, we know what to do with the money and we will be able to pay. Competitive advantage. Why us? Why this company? One, we have a very good, the company, the competition, not competitive advantage. The competitive advantage is later. The competition, who are the other players? There is Mugire Rice Company, Murefu and Sons Rice Producers Limited, Murokire Rice Producers and Suppliers Limited. These established competitors have enjoyed the market for over a decade, indicating a competitive landscape. Simply, we are saying we are not going to the market alone. There are some other players, and these are guys who have been there for long. But what is our advantage? What are we offering that will give us an advantage? Number one, environmentally friendly packaging. Maybe they don't do that. So appeals to growing customer awareness and differentiating from existing players. That is what we'll do. We're doing different from others. Online business and delivery services. We are telling the bank that apart from waiting for the customers to come and buy, we will do online marketing. We will be delivering to the customers. So it tried to give a convincing power and a wider reach, leveraging modern sales technology to reach more customers. Then, what are we going to do with our customers? We are going to give affordable prices and high quality. So from our mission, we are saying that we will emphasize on customer quality, on the product quality and affordability of our products. Then if you are going to look at the price in operation, how are we going to carry out the operation? One, facilities. We require facility for rice milling and processing in Gasibo district. That is, more details we can provide them in the appendices. We can now give the specification of the equipment. We need a machine. This machine will come from China. This, you see that. Then what is our supply chain? Sourcing new raw rice from farmers. In this case, the bank can require more details. Do we have any contract that we have already discussed with the farmers, are waiting for the signing? We can show that in the appendices. The distribution channel, we are using the online platform. We'll be offering delivery services, direct sales to restaurants, schools, supermarket, and distributors. What personnel do we have that will facilitate the operation? Apart from the management, we intend to have 25 employees. So that is the operation of our company. Now let us try to discuss about the financial part. How much do we need? 150. Remember, we said that shareholders will be raising 60%, which is 90 billion. How much do we need from the bank? We need from the bank 40%, an equivalent of 60 billion. 60 billion. So this is what will help us to achieve our objective. And what is the objective in question? Let us give them our forecast. I want you to do this. 2 minutes. Can you compute? From the question, we are told that year one, revenue is 100 million. This will grow by 10%. Take 10% of 100 million. You take 15% of year two. You take 20% of year three. You take 14% for year four to get year five. Can you confirm that these figures are correct as per the statement given? 2 minutes, please put them in your calculator. Put them in your calculator and confirm for me that my calculation is correct. 110% of 100, 115% of 110, 120% of 126.5, like that to the end. Let me see from the chat box whether these figures are correct. If they are not correct, please state there. I may have done the wrong computation. Yeah, sure. I think they are okay. So remember in the question, if I refer back to the question, we are told that the sales forecast are 100 million for the first year, which will increase at 10% in the second year, 15%, 20%, and 14% in the third, fourth, and fifth year, respectively. That is what we have used. Then we have the costs. Remember the cost we are given, and we have the profit. So I just gave an overview of what is given. Then we are told that the break-even is expected at the earliest point, which is year one. That is so positive when you are raising a bank. So that is the financial perspective based on the information that we have. Now, key features for bank consideration. Why the bank should fund the company. One, strong equity contribution. Remember, the shareholders will raise 60%. The bank we expect to get from the bank 40%. So we have a strong equity. Number two, these are the things that will convince the bank, or you are trying to tell the bank, why do we qualify for this one? Experience, leadership, and governance. Mrs. Igambire, master's degree in agricultural business and vast experience, complied with 9 members board with diverse experience and a full historical team. That is the director team indicate competent management capable of executing the business plan. So if you need to cite that to the bank, clear competitive advantage. So we are giving a summary of why we think the bank should consider advancing the loan. The focus on eco-friendly packaging, online sales and delivery service offers clear differentiation in the competitive market, suggesting a viable strategy to capture market share. Then we have the realistic and positive financial projection. The 5-year sales and profit forecast show that there is a consistent growth indicating strong revenue potential and profitability. The expectation to break even in year one is another power. Market niche and demand, targeting broad customer base. We have listed the market. Why do we think these customers will come to us? Affordable prices and super quality. Then scalability of the business model. The combination of traditional distribution with online delivery services suggests a scalable model. So we are combining the conventional and the modern. Then contribution to local economy. This one we say that the employment of 25 people and potentially engagement with the local farmers for sourcing would contribute positively to the local economy, which can be a favorable factor. So at least we are highlighting what we feel should convince. We are trying to tell the bank, consider us because of these factors. Then the last point is funding. The company requests a loan of Rwandan francs 60 billion, 40% of the total initial capital to fund its establishment and initial operation as detailed in the financial plan. This funding will enable the company to acquire necessary assets, set up the milling and processing plant, and commence its market entry strategy. So I just gave that overview to the business plan, which I believe is something that will help us in answering such questions and possibly some other questions. So what I want us to do, at least I have given a good question that from what we have covered so far from yesterday, we can say that if that was the only question in the exam, you would say that there is something that you have done. To always have open mind in the exam, I would advise don't leave the exam. Don't leave any question unanswered. You have an opportunity to always pass, considering that you got that strong argument. Good. Allow me to say that for that first topic, I have given enough of the time. Remember, there is a lot that we need to do for other topics. I want us to go to another topic, and this is merger and acquisition. Merger and acquisition, where I believe we will be able to learn some new things, and you will always get what is right. I want to give you 5 minutes for a glass of water. 5 minutes for a glass of water, stretch, before we go to a new topic. Please take 5 minutes for a break. Then we will be back together. Merger and acquisition. The break starts now. We are meeting back at 7:26.
Mbona sana nyina Siraza nuko biragenda sibyo bice bite byagenze bite ngo ngwiki
bazajya bihakana
turi mu kanya ko kwivuga nubwo nari nabaye bite amazina nanjye nimufashemo muri rero duturanye na mugore aho avuka turiya turaturanye yego ubwo ari byo ngibyo aha byagera aho kuba atahaje ntawe yahayobewe yego arahumva ariko sinduze ko ni hafi ntuzi ko ureba hakurya kwishyara
muri mvura cyangwa muri batanga
sinduze uriya nzu ni kaminuza ubwo nyamashini wanyurwa kwicara
Kwicara ni agace ka kwicara.
yewe nta nyamateka ariko umwihariko
Kabagabura amateke.
yego
Gako kazi karakaye.
ariko buriya abanzi kwa Rufunzo hari telefone uretse ko abantu dukorana ahantu hose barahazi
yego
nta murenge
ariko ntibyabura kubera bakunda kugenda
bibajyaho cyane
ishema Joana Arabia
Ubwo bisobanuye
byase Shema Mukashema bano bombi ni bayishema
bose ntibashira.
ba ishema ba shema ni ba dada
Shema Mukashema.
Eh,
Urufari.
azi ko no ku kazi kazi waramubazaga se wahinduye izina byagenze bite agati k'umuntu ufite ubwo bubasha ari perezida wenyine ari we uhita uhindura izina ryiwe ry'umugabo we
Joana ukubagana sheri ukubagana bibi oh yes
abe
yego zitwa Claudette
Hagati y'umwana politiki.
ese we dasi buracyari premiza ese nako waryanze kera ese ko byashize
Rero umukobwa
ariko dasi we ntacyo bitwaye
Aha ry'abakecuru ni kano baye nabiki.
Hino hari ikibazo hadativa nta ruwizi yewe yego nawe rigiye
nawe rikajyamo
nka bimwe by'abasore umuryango wa Antoni ukaba ufite umuryango
birakunda ariko numva babisoma kuri radiyo iyo bahinduje barabisoma bakavuga n'impamvu Cervantes.
ashobora no kuryanga buriya akakaguma kabiri ariko n'ibitotsi birimo kumuriza iyo ari izina rya
umwana akagira izina
ingabo
umwana w'igisore
ibitotsi n'igice
byafashije
igikoma cyakoze akazi kabitubona akashi yavukanye ibitotsi n'igice ntore rero se umwana aba yaravutse angana gutya
yewe arabaye
Nzane ntiyabaga
nta n'umunzani abapfaga kubona
abana wari
bazarabimenya
abantu benshi nka mbere yacu ho gatoya benshi bahukiye mu rugo ntibanabyitaga
ariko buriya mu rugo iwacu ngira umwana wavukiye kwa muganga yewe na David avutse nyuma yanjye yavukiye mu rugo
benshi bahukiraga mu rugo
So I believe we are now set to get into the next level or the next topic, and this is merger and acquisition. This is our second topic, merger and acquisition. Are you there? Let me see by the show whether you are there or I am alone. Someone to respond and tell me whether you are there.
wenyine
Are you in for this second session? Let me see. Are you there? Good. Someone says yes. Someone yes. Good. Good. So it means that I'm not alone. Yes. Welcome. We move together. I hope this one you will understand it. I just wish there is something I could make you to understand. Go to the exam, sit. This is not a paper to fail, please. Of all the other things that you think of, never have any room to fail corporate finance. Never create a room to fail corporate finance. I want us to record 100% pass mark, pass rate. This is very possible. Let us move. Merger and acquisition. Merger and acquisition. Before I get to explaining the other factors about the merger and acquisition, I would want someone to write and tell me, what do you think merger is? What do you think merger is? And what do you think acquisition is? What do you think merger is? And what do you think acquisition is? Is there any difference? What is merger? What is acquisition? Just put a small write-up. Put a small write-up here. I want to see. Just do a small write-up. Someone says that merger is a combination of two farms to form one. Good. Let's hear from another person. What is merger? What is acquisition? What is merger? What is acquisition? Let me see what you say merger is. What is acquisition? What is merger? What is acquisition? Merger is amalgamation with another company. Yes, that is another person. Let's hear from another one. What is merger? What is acquisition? Is there any difference? Merger is coming together of two firms. Oh, that one has disappeared. Merger is a combination of two companies into one, while acquisition is takeover. There's someone who has done an equation, or there are many. Merger is coming together of two firms. Acquisition is buying another company. Merger is the combination of two companies. Acquisition is when one company acquires another company. It may acquire entire company or part of the company. Merger is a good. Thank you so much. Let us separate wheat from chaff. Merger and acquisition. I want to give it, okay. For all the purpose of this topic, we will be using merger and acquisition interchangeably. Interchangeably means we will be treating as if they mean the same. We will be treating them as if they mean the same. But I want to give this to separate. In a merger, or let me put it in a way that it will look the same, but I will give the difference. Two or more companies, more firms, combine to form a single entity. In merger, two or more firms to form a single entity. However, this is what separates. However, in merger, the identity of the firms disappear for a new identity. E.g., for example, A Limited plus B Limited to form AB Limited. What does this mean? Sorry. What did I do? To form AB Limited. This means that the original company independent was A, the other company was B, but they formed a new company called AB Limited. This means you change the identity. We knew a company known as A Limited. It is no longer there. We have a completely new company. That one we say that A Limited plus B Limited to form AB Limited. Now, let me use the same statement to explain acquisition. I will use the same to explain acquisition. Two or more firms combine to form a single entity. That holds. However, in acquisition, the identity
ahantu mu nzu yahawe
of
How
one
do you
farm, of
none abandi
one
yabihanze
farm.
none abandi
One farm
umuryango
remains
Kandi mwana afite urinda
oya
as
yego
the
nyine
identity of the others, as the identity of the others disappear, e.g., A plus B, we have A limited. So the identity of B disappeared, and we have a new firm called A limited. That is an acquisition. An acquisition.
ntabwo
Merger, the identity of the two companies will cease, and a new one is established. In acquisition, one company dominates the other. After the acquisition, its identity remains. I want you to get that. But for the purpose of whatever we'll be doing, we'll be dealing with them as
yakwemerera
we'll be dealing with them interchangeably.
Muri ubuzima utamenyereye.
Having explained that, I want to say this. Merger and acquisition represent a significant avenue for corporate growth.
imana izamufashe
From organic expansion, we say there is organic growth and inorganic growth. Organic growth, the company grows itself. In an inorganic growth, there is external forces. I'm sure from the question that we just done, there is a lot of agricultural activities in Rwanda.
nkagutya
A lot of agricultural activities in
noneho
Rwanda.
muri kubona
Now,
twerewe
I know you know that. I'm sure you know the people who does poultry farming, the broiler, the chicken for
ubu
meat.
urazi kugendana abana gutya
There is organic growth where you rear the chicken, they grow by themselves. There is an inorganic one where people inject the chicken
uyu
to fatten, to grow. That's what we are saying even in business. There is an organic way of the self-growth, and there is an inorganic way where it is derived by external force, like merger and
ariko iyo bari mu
acquisition.
kigero nk'iki ngiki
So organic versus acquisition growth. Organic growth, this is internal expansion through existing operation. You market, the business generates more revenue, you reinvest, the business will grow. Acquisition growth, it is external. External growth by purchasing or merging with other companies. So it is good to understand that. Now, there is this definition that I will put, but the one that I did put first, that one tried to give a clear overview. So merger, two companies unite to form a single new entity, often a mutual decision, a single new entity. That's what I said. Acquisition or takeover, one company purchases or controls the interest in another, can be friendly or hostile. We'll be looking at hostile takeover. Hostile takeover. I want to ask you a question, and I hope you will not feel uncomfortable about it. Don't answer me, but you can answer if you want. You can light it there on the wall. Sometimes we need to look at our real life. Let me ask you a question. We've said in merger, two come together, two or more come together to form one entity. The identity is for both. In acquisition, two come together. The identity of one is swallowed by the other one. So one is taken by the other one. Let me ask you a social question. Is marriage merger or acquisition? Is marriage merger or acquisition? The way you answer it, it should tell me whether you understand merger and acquisition. As you are answering that one, as you are thinking about that, let us move to the next item. Type of combination. The reason we are saying type of combination, it can be combination through merger or acquisition. We said we will use them interchangeably. Types of combination. 1, vertical combination, vertical integration. Okay, I want to put it this way. The examiner will tell you, define vertical merger. Don't say that I said vertical integration. No, it means the same. If the examiner tell you, define vertical merger, define vertical acquisition, define vertical integration, define vertical combination, they all mean the same. What is vertical merger? What is vertical integration? It is a combination of two or more firms that are in different levels of productivity. Combination of two or more firms that are in different levels of activity. They are in the same industry, but at different stages. For example, a milk processing company in Kigali can acquire a farm that rear dairy cattle. Now look at this. A milk processing company merge with a dairy cattle farm. They are in the same industry, but the milk processing company uses the output of the cattle farming. That is a vertical merger. A bottling company will be acquired by a beer company. Beer uses bottles. So in vertical merger, it is to ensure a guaranteed source of material and to create a market. When a milk processing company acquires a cattle farming company, it means the products from the farm will have a market in the processing company. And this processing company has a source of raw material. That is called a vertical merger. Horizontal merger or horizontal integration. A horizontal integration is where farms in the same level will combine together to form a bigger farm. So they are horizontal. They are in the same industry and mostly in the same level. For example, Simba Supermarket in Kigali can acquire, I don't know which is that other supermarket in Kigali. I only know the Simba Supermarket. So Simba Supermarket acquire another supermarket in Kigali. Or University of Kigali acquires MKU to form one big university. That will result to a horizontal integration. They are in the same industry and at the same level. Why do we do that? To enjoy the economies of scale. To have a wider market. You see, when you have a wider market, you enjoy the economies of scale. Remember, the first one is to create market and source of input. Horizontal is to enjoy the wide economies of scale. Then we have what we call conglomerate merger. The conglomerate merger is a combination of two or more firms that are not related. They are not in the same industry. For example, a bank can decide to invest in telecom. A bank and telecom, they don't have any much relation because they are in different industries. A dairy farm can acquire a supermarket. They are in different industries. That one we call it congruent merger. Why congruent merger? For risk diversification. So I want to know to put these points so that at least they can help us. This is for
kuri telefone y'inyarwanda
guaranteed supply and guaranteed market. This is for guaranteed supply of input, and guaranteed market of output. Now, for the horizontal integration or the horizontal merger, we say that this is to enjoy the economies of scale. This is to enjoy the economies of scale. When you are big, you enjoy the economies of scale. Then we have this one. This is for risk diversification. This is for risk diversification. I want you to look at it from that perspective. It is good to understand. I have explained that. Argument for merger and acquisition. Why merger? Why acquisition? Why would you say that merger is good, acquisition is good? We say that we will use them interchangeably. Let me see whether there is something that you have written on the wall. I don't want to be left out. Someone may have something written or a question. It is good. Someone says that marriage is a merger. Another one says that it will depend on the marriage contract. So do we have marriage contract? Two mutually meet and form a family. Someone says it is a merger. Marriage is a merger. Marriage is like merger. Hey, almost everyone says it is merger. Marriage is merger. That is good. It's social. That is a social life. Hey, everybody says it is a merger. Good. Thank you. That's social life. And we can never separate ourselves from the society. In that one, you can try to discuss it with your spouse and see what they say. But a majority says it is a merger. Thank you. Now let us look at the argument for merger and acquisition. One, synergy. Synergy means you will enjoy a synergetic gain. Instead of saying that 1 + 1 is 2, you will make 1 + 1 and get 3. Why? Because there is another energy that comes. The combined entity value or performance exceeds the sum of its individual parts. This is often through cost reduction. The reason it is, we talk of the synergetic gain, if today a supermarket in Kigali combined with another supermarket in Kigali, they will be able to negotiate from the supplier because they will be buying in bulk. They will be able to import. They will be able to go to the farmers direct. They will be able to negotiate. So it gives reduced cost, and as a result, the profitability increases. Synergetic gain. Number 2, economies of scale. When you talk of the economies of scale, there are other gains that come with a bigger entity. Look at it this way. One company has a CEO paying the CEO 5 million Rwandan francs. The other one has a CEO paying 5 million Rwandan francs. In total, they are both paying 10. When they come together, they will get the best CEO. Maybe there is a good CEO who we can pay 7 million Rwandan francs. So you will eliminate the two of 5 and get a better one who will bring in more experience and expertise who individually would not have been able to pay. We bring a better one and more experienced. We pay 7 million, meaning we will get a better CEO at a lower cost. Because the two separate, we are paying 10. But individually, they may not have the experience and the qualification than the one who would cost 7. So there is that economies of scale. When it comes to the marketing, when you place an advert, it reaches people to be served by a bigger entity. When it comes to the production, you do the production to get more output, and you have a bigger image. New market entry. Sometimes you acquire to venture into a new market. For example, I don't know how big is the biggest supermarket in Rwanda. I suspect Simba Supermarket could be the biggest. Suppose Simba Supermarket want to venture into the Kenyan market. It would be a little difficult. So the way that Simba Supermarket can get into Kenyan market, they can come and identify a smaller Kenyan supermarket, they acquire it. All the customers who are in Kenyan supermarket will revert to the Rwandese supermarket. You are able to get into other market by acquiring and merger. Management acquisition. A company can acquire another one to bring into management, experience, and better team. Sometimes companies do that. They look at a company, that company has very nice managers, but they do not have resources. You can merge and have those best management. Diversification, as I said, in the merger and acquisition, the conglomerate merger and acquisition, we can acquire to diversify risk. A bank can acquire a supermarket so that in case the banking industry is not performing, they will reap from the supermarket. Increased market share and power. Of course, when the management or when a company has acquired another one, they can enjoy monopolistic power. They can create a big empire that will have influence in the market. The other one is booster asset backing. Sometimes it will be easier to acquire a company with its assets than buying new assets. Buying new assets could be expensive. Growth. A company will grow, as we said, can grow organically, and also can grow through merging with others. Companies come together, they merge together, they make a bigger company. Taxation. We know that cumulative losses are allowable for taxes on future profit. So a company, and let me give you an example. I am sure about 2 weeks ago, the Minister for Finance in Rwanda presented the national budget, and the Parliament approved the finance bill, the Rwanda finance bill for year 2026-2027. That was standard in all East African countries. Even Kenya, we did that. Kenya, in its amendment of the finance bill under the current Finance Act, they passed a law that if a company has losses, they can only be claimed over a period of 5 years only. After the 5th year, you write off those losses. You cannot claim them for tax purposes. So now we look at the strategies to taxation, to managing taxation. If a company has cumulative losses for 4 years and they feel that they will end the 5th year without having claimed those losses, they can get another company to merge so that another profitable company to merge so that the losses will be claimed by the other company. That is what we say unutilized tax allowances and losses. The other one is to reduce competition. Company can join together to reduce competition. Instead of concentrating on competition, they concentrate on business. So there is reduction of competition. It helps in managing the competition. The other advantage is asset striping. The company, okay, let me put this one. There is bolster asset acquisition, and there is what we call the striping of assets. The striping of assets means you can acquire a company, you sell it in piecemeal. Striping of asset, acquire a company, but sell, once you acquire it, you break it down, you sell asset. Maybe company has land, you sell land separately, you sell machinery separately, you sell vehicles separately, you sell furniture separately, you are likely to make more profit. We call it asset striping or breakup of the asset or piecemeal disposal. The other one is use of surplus cash. A company will acquire another one because it feels that it has a lot of cash. There is a lot of cash. What do we do with this surplus cash? Invest by acquiring. The next one is lower cost of financing. We know that a small investor will be charged high interest rate by the bank. A big company will have a bargaining power from the bank. So how does this work? Make your company big. Because of the assets that you have created and the goodwill, you can negotiate with the bank for lower interest rates. So always, big companies negotiate for low interest rates. The other one is improvement in the gearing. A company may be overburdened by debt. Its gearing level could be high. It can merge with another one so as to increase on equity, to improve on equity. So equity, because one company has a lot of equity, you merge with that one that is has debt, you make more equity, and that one will receive a gearing level. Then purchase of patent and brands. There are companies that have intellectual property, and there are others that do not have intellectual property. A company can acquire another one with the intellectual property to enjoy the benefit of the intellectual property. Is there any question? Is there any question? Post the question if there is. Post the question if there is. I'm looking at the chart to see whether there is any question. Oh, I think there is. Someone says that marriage and merger sound the same. Okay. What could be the reason of takeover in a friend way, not hostile way? What could be the reason of takeover? Okay. That question, I will answer it in a later position, but I can highlight it a retro because someone has asked. You will forgive my pronunciation when you see me avoiding. It's because I feel I might pronounce your name in the wrong way. That is why I'm avoiding to read the name. But I see someone says, what could be the reason of takeover in I believe your question was in a friendly way instead of the hostile one. One, a friendly way is where the shareholders of both companies sit and agree. Let us merge, or I want to sell my company. A hostile takeover, this is where a company is acquired by force. And acquisition by force is you go to the stock market, you buy the shares of another company because you want to take control of that company. This one has happened this year in Kenya, and actually this one was not on a public company. It was a private company. There is a very big company called Direct Line Insurance Company. That company was taken over by some investors by force, and they are in legal tussles, but the original owner seemed to have lost it. So the hostile takeover is you take it in an friendly way. A friendly way is where you feel that you want to do it. Hostile takeover, one of the parties does not want to have it. But we'll get back to it because we need to look at how do we prevent hostile takeover. Someone says that SIBA has acquired Nakumatt. No. That one, of course, you also put a disclaimer if you are not mistaken. SIBA did not acquire Nakumatt. Nakumatt collapsed. Nakumatt died. So, at the point of its death, there are those supermarkets that we are ready to go and take that facility. They bought them in piecemeal. So it is not necessarily acquisition because I understand SIBA, and maybe someone can tell me how many branches does SIBA has? We see its capacity of acquiring Nakumatt. They occupied the space that was at the Nakumatt. Which is more preferable between... someone has asked a question, did they disappear? Which is more preferable between organic or inorganic growth strategy? Okay, none is preferable. It is the circumstances that determine. Because some people will feel, let me just grow my big business organically. It is good. Someone will say that let me acquire, let us match. It is equally good. So you cannot say which one is preferable than other. As long as the right procedure is followed, it is still okay. Someone says that SIBA has so many branches. Let me give you, okay, let's continue. The biggest supermarket in Kenya is Naivas with 108 branches. I doubt SIBA could be having such a number of branches. Nakumatt had about 60. So I don't think SIBA had a capacity to acquire Nakumatt. It only did the space that was at the Nakumatt. Now let us look at why merger. Why not merger? Merger, sometimes merger, we've tried merger, it has failed. Why merger? What causes the failure of merger and acquisition? What are those disadvantages of merger and acquisition? Number one, poor strategic fit. sometimes a company will merge with another one, or they will acquire another one, but there is a lot of conflict in what they believe in their strategic belief. For example, a company can acquire another one. They want to venture into business in other countries. So one company want to go to the very risky countries, the DRC, the likes of South Sudan. So once they merge, they feel that no. For us, we are not in that kind of business. We cannot go into those very risky areas. So the strategy differ. Or one is comfortable in getting into technology, the other one feel that no, we are not going into much technology. So these are the things that you consider. That is one thing: strategic fit, failure to fit in your strategy. The other one is cultural and social differences. Sometimes shareholders would want, but the culture does not. I will give an example of restaurants. Culturally, Islamic have the way they like in hotels. If a Muslim restaurant is acquired with another, a conventional one, you might find that the culture may differ. Because if it is the consumption of the meat, the way the slaughtering is done, that one can differ. So there is the social difference and the cultural difference. So the problem is that what you believe in may not fit. So we got the people may fail to integrate, the disintegration of the people because of what they believe in. Then the other one is incomplete and inadequate due diligence. You wanted to acquire, you wanted to merge, but you did not get the full information about the other company. We say that failure to do due diligence or adequate due diligence can cause a problem. You need to have due diligence, full information, so that you are making the decision from an informed position. So failure to thoroughly investigate and target company's operation, financial, legal aspect. Maybe you acquired a company, it had some legal issues that were never resolved, you never knew about that. Then when you get into it, you feel like you are making a mistake. So let us part ways. That can cause a failure. Poor management integration. At the point of integration, there is need to do professional approach. How do we do the planning? How is it executed? I remember one time I was involved in merger of two firms. They had seek consultant to facilitate the merger. And the first thing that you do is you come up with a plan. Number one, you come up with understanding of a company, each company. You look, you list, you document the likes, and on the other side, you document the dislikes, those things that are not similar. Then you come up with a plan. Those that are similar will integrate. Those ones that are not similar, how are we going to integrate them? So we do an execution in combining the two entities. That can cause a problem. You fail to manage that integration, a poor integration. You look at the rights, you forget about the dislikes. Then paying too much overpayment. We will be looking at the consideration in merger and acquisition. Sometimes when you are acquiring a company, you may end up paying too much. So it will erode your cash flow. Then the shareholders will feel demotivated because they feel that they are cheated. So those are things that can cause problems. The other thing is too much optimism, overly optimistic projections. You are presented with the forecasts and the projections. They are too much. You are too optimistic, but when you get there, you realize this was not realistic. So unrealistic optimism, that can cause a problem. Negative or impact on bidding company shareholder. The shareholders can feel that their earnings per share, we call it dilutive and non-dilutive. The diluting of the earnings per share can be diluted after the merger. So that one can also cause a problem in integration. The other one is resistance from the target. I want to define what is the meaning of the target. We have two parties in a merger, a predator and a target. A predator is the firm acquiring, a target is the firm being acquired. Resistance from the target company is a company A wants to acquire a company B, but B is defensive. B does not want. So the management and all shareholders of target company may reject the offer due to unfavorable term. In most cases, you will find that the shareholders or the management want a company to be acquired. But on the other end, shareholders do not want. So they resist. That is another challenge that can cause a problem in merger and acquisition. The other thing is the employee opposition. The employees can make it difficult for merger to succeed. Your company is to be acquired, but you make sure that you make things difficult. You don't cooperate. You give misleading information. Employee can cause a problem. And I think that one is okay, unless someone has a question. Good. The next thing that we need to look at is the overall merger and acquisition. Is there anyone with a question? If someone has a question, I can look at that. Someone is saying, is there any situation that an entity needs to be acquired? That question is right. Is there a question that an entity needs to be acquired? Yes. So many cases where the shareholder wishes who will buy this company. The management is asking who will buy this company. They feel they just want to be acquired. There are so many cases. So that is real. There are many cases that a company needs to be acquired. It is not only the predator that feel like they want to acquire. Even the target may feel like we need to be acquired. That question. So let us continue. Overall merger and acquisition process. What is the process? As I said, we encounter challenges when it comes to the integration of merger and acquisition. And we need to look at the phases in merger and acquisition. How best can we do merger and acquisition to achieve the objective and to outlive the challenges of merger and acquisition? Number one, phase one, pre-acquisition review. Make sure that you assess the acquiring company and the company that need to be acquired. Evaluate what benefit will come if the acquisition was to happen or the merger was to happen. Once you do that assessment, you can come up with a team that will help now to carry out the process. The second phase is search and screen the target. The target should screen the viability of the predator and the predator should screen the viability of the target. So it is good if you want to acquire a company, look at a target that can fit your business, the viability. Then the third phase, it is the investigate and value the target. That is where we talked about the due diligence. You need to know more about the target that you want to acquire, get more details, get the financials, get the data about the acquisition, the past performance, determine the value, ascertain whether this company has issues like legal cases that are pending in the court. Is there a conflict, an existing conflict between the shareholders and the managers? You look at all that. That is the investigation. You need to get the clear information. The next one is acquire through negotiation. Develop a strategy to discussing, a strategy to negotiating, sit, discuss, agree, move together, work together. So that is what we are saying, the negotiation. When it comes to this, the negotiation part, we can look at it from different perspectives. The first one is an agreement between the two parties. We call it negotiated merger or the bear hug. If the examiner tell you, explain what is bear hug in merger and acquisition. It is a negotiation where two parties come together and they both agree. It's called a bear hug. The other one is still hold possession. This is where one party will position something so as to influence the other one or to encourage the other one into the negotiation. You look at one company and say, you guys, you have a lot of problems, you have a lot of debts, and there is a very big potential in the market. We think that if we get into a merger, we will solve your problems. You have created something that will make the other party to be interested in the negotiation. The other one is an offer in a tendering process. In this case, you make an offer. You say that we want to acquire that company. You go and tell them, that is, you issue an offer, issuing of an offer, tendering of an offer. You go and tell them, we would want to buy you at 10 billion Rwandan francs. So the question is, are you ready to take up that money? You go approach the major shareholders. You tell them, why can't you sell this company to us? You see, that is something that it is started by the predator. They give an offer. Due diligence, of course, that one is about you negotiate based on the information that you have. You tell them, you guys, we've noted you have a court case, so we will pay this much. You are negotiating, but there is that information that you have. Then the other phase is after the merger, after the deal has been signed, you have entered into that merger, you have entered into that acquisition. There is what we call post-merger integration. This is the phase where everything is done, but if you do things wrong, you will bring down the entire deal. There are different levels of integration. The first one is integration level 1 is full integration level, where all functions and activities are brought together at once and the operation starts. There is the other one, the moderate integration, where we start with the key functions. We start with the key functions, then we will gradually move to the other small functions. So we can, if it is a bank, two banks are merging, you start running the customers together, but the loans are managed separately. You merge some branches, the headquarters, the big branches gradually. Then we go to the minimum. You can only take a very small function, you merge them, but you leave the other part for future consideration. Like I've seen cases where companies have come together, but they only merge the management. Everything else is separate, only the management. They have a common management team, but everything else is different. Is running separately. So that one you give a minimum integration level. So those are the steps that we look at when it comes to that part of merger and acquisition. The key challenges in merger and acquisition and their phases is to realize the expected synergies. We will do that in computation. We see how we deal with the synergetic gains and managing culture and operational differences. So there is challenge of realizing expected synergy and managing the cultural and operational differences. Good. Ask a question. We are almost winding up. I don't think we are left with much. Oh, is this? Yes, it's not that much. So if there is a question, someone can ask. Now, I want us to look at the next part, and this is when it comes to the issue of merger and acquisition. What is the consideration? We call it form of consideration, purchase consideration, the method of financing, all that. Number one, cash payment. A company want to acquire another. The predator want to acquire a target. The predator take cash, go and pay the shareholders in the target. The shareholders of the target just go home. They are given money. The other one, we call it the share exchange. We say that, let me give the University of Kigali want to combine with the Mount Kenya University or the MKU. They want to come together. They say we will come together, but the shareholders in University of Kigali and the shareholders in the University of MKU, they will be shareholders in the new university. So we call it a share exchange. In the new entity, how many shares will the shareholder from University of Kigali get for every share they hold? So if I had 10 shares in University of Kigali, how many shares will I be given in the new entity? Maybe for every 10, I will be given 5. So it's called a share exchange. The other one is loan stock, issue of debt instruments. I want us to get it right. Let me use the universities because I'm trying to look at the business that I could be familiar with in Rwanda. Banking industry. Let me give the banking industry, the Equity Bank of Kenya and the Bank of Kigali. We can say that shareholders in the Bank of Kigali will remain the shareholder after the Bank of Kigali has merged with the Equity Bank. The shareholders in Equity Bank will not be given cash and they will not become shareholders. What will happen? Their equity will become a loan. So they will be earning interest from the new entity. So the shareholder in the target become a debt provider. Their part is taken as a loan. And the last one, it is a combination of any two or all the three. Some part is paid in cash, the other one in shares. Some part is paid in cash, the other one in loan. Some part is shares and the other one is loan, or some part is cash, the other part is share, the other part is loan, a combination. Please always remember this. Cash consideration, share exchange, loan stock, all debt, and the last one is a combination of any two or all the three. Any question? So those are the common ones, but we can also look at the deferred expenditure, where the payment will be dependent on the future performance. That is another consideration, but not very common. Now, factors to consider when choosing a consideration method. What do you look at when you are deciding, is it cash, is it share for share, is it debt, or a combination? Number one, dilution of the earnings per share. I will explain that from a computation perspective. Don't worry about that word dilution. But what I want to say, if my earnings per share is 5, after I have entered into acquisition, will it go to 4? That is what we call dilution. The other one is cost. What is the cost when it comes to that acquisition? Sometimes when you convert to debt, the company will enjoy interest tax shield, because interest is allowable. The other one is gearing. If the companies have huge debts, they should go for share. Why? Because it will not increase the debt. Gearing is a factor. Control, if the shareholders of the predator want to maintain the control, they can pay the target shareholders cash or they give them debt, because they want to maintain control through shareholding. The other one is cash resources. If the company is in a liquidity problem, or it feels that after acquisition a lot of cash will be spent, the company can use a debt or equity instead of paying cash. Then price certainty, cash offer a fixed value, share exchange value fluctuate. There is that certainty. If the predator want to sell their ownership, they would feel, if we take shares, we don't know what will be the price of these shares in the future. So let us take cash. So we need to get the certainty. Then when it comes from the target, the company being acquired, what do they consider? The taxation. When you pay someone in cash, they may be taxed on capital gain. But when you pay them shares, they will not be taxed, because it is just the ownership transfer. The other thing is, when the predator is considering that they are going to be acquired, they will ask themselves, is there any benefit on income? Are we going to get more income? So if we are going, we can accept shares. If they are not, let's take cash. The other one is future investment. Someone will ask, if I take shares, I will become a shareholder in a bigger company. That is a good investment. Then value certainty, as we said, cash is a factor. Then the risk, when you issue shares, As a shareholder, you take the risk of the big company, but if you are issued debentures, you know that you are guaranteed on interest. There is an interest guarantee. I'm trying to move fast because I want us to finish this theory part so that when we meet next time, we will look at computation. So you know that I'm trying to explain fast. We may not spend a lot of time on theory. Now, we mentioned earlier that you can have a friendly takeover and a hostile takeover. A hostile takeover happens when the predator wants to acquire the target by force. Like you can study in the Rwanda Stock Exchange, you look at a company, see that it is undervalued. Then you say that let us acquire this company. Then the shareholder of the target will realize there is someone who wants to acquire us through the stock market. So how can we protect ourselves? Number one, poison pill. We call it poison pill. And please note these terms. The examiner will test them. He will ask you, what is poison pill in merger and acquisition? We say that it is giving shareholders the right to buy new shares at a discount if a hostile bid reaches a certain threshold, making the target company less attractive. So the poison pill is a company would want to be one company want to acquire another company, but the company to be acquired make it that we will not be acquired unless you get to this level. Otherwise, we just remain like that. So it is like making it difficult for the company to be acquired through making it difficult to have the shares. Like a target company will make its shares unavailable to be acquired by the predator. The other one is what we call the white meat. A white meat means company A want to acquire company B, but company B feels that we don't want to be acquired by company A. But because we must be acquired, company B will acquire company C and tell it, please acquire us, so that we may not be acquired by company A. We say that seeking a more friendly predator. That is called white meat. White meat, a more friendly predator to acquire. The other one is called green mail. A green mail, if you want to acquire a company that is listed in Rwanda Securities Exchange, you can go, although this one in Kenya, this one is not acceptable. The company can go back to the market and buy its own shares. I don't know how it is in Rwanda, but when you look at company in countries like US, in some states, it is acceptable that a company can go to the market and buy its own shares. That one, we call it a green mail. When you know that you're about to be acquired, because your shares are undervalued in the market, you go into the market and buy your shares. These shares are called treasury shares. In your financial reporting, you will see something called treasury shares. That treasury shares is the company buy its own shares to make them unavailable in the market for acquisition. The other one is staggered board. Now, the staggered board, we know that sometimes the board of directors are the ones who pass issues like acquisition. So what the shareholders do, they give short terms and terms where, like the chairman can serve for 5 years, but the chairman will not come to the office at the same time with the CEO. And like there is no single term time that you will have all the board members, they joined at the same time and they have a short life. So it is like you destabilize the board of management to make them difficult to agree to sell the company. You stagger the board of management. The other one is what we call the crown jewel. The crown jewel, every company that is to be acquired, there is that part that attract the predator. You can liquidate it, you can sell it off. Maybe a company has a product that is very well known. You feel that this is the one that is attracting the predator. You can remove it, you can sell it off. Sell of the key asset, that crown jewel, that's what is making it attractive. Crown jewel, sale of the crown jewel. The other one is what we call the Pacman's defense. Pacman's defense. Pacman's defense. Allow me to take you back to the social life. Where we started, I started by asking, is marriage a merger and an or acquisition? In marriage, we believe that it is an agreement between two parties, but there is the one that proposes to the other one. So you propose to someone and tell them, mostly men propose to women that, can I marry you? Now, the lady decide to use a Pacman defense. She tell you, I will marry you instead. You are man, you approached a lady to tell them that, can I marry you? Then the lady tell you, no, you cannot marry me. I will marry you instead. That automatically will put the man off. It happened in merger and acquisition. A company want to acquire another one. The other one now say, we will acquire you instead. So a company decide, we want to buy your shares in the stock market. Then this other one start the process of buying the original predator shares. So that is called Pacman's defense. You make an offer, a counter offer, when one company wants to acquire you. Pacman's defense. Shareholders' right plans. This is where a provision in the company can make it difficult for a company to acquire another one. There are provisions that may be put in the company that can make a company acquire, and there are some ones that can make it difficult to acquire. So we say that the shareholders' right plans, they can put a right and say that our company will never be acquired. They make a provision in their constitution that they will never be acquired. So even if the management want, it is difficult because the shareholders has made it as such. The other one is golden parachutes. The golden parachute come with the management, where if a company A want to acquire company B, we know that we cannot have two CEOs. A company A has a CEO and a full board of management. A company B has a full board of management and the CEO. If these companies are going to merge, who will go home? A golden parachute come by the shareholders or the management of the company to be acquired, make it expensive. If we are going to go home, our package of going home should be very high. It will become expensive to the acquiring company. The other one is just to say no. No, just say no. We don't want to be acquired. You want to acquire us? No, we don't want to be acquired. Period. And that is all. Then the other one or the last one is legal charges. Sometimes companies want to acquire others, as we said, to enjoy monopolistic gains. To prevent monopolistic gains, someone can go to the court of law and seek for the defense from the court. You can block it in the court of law, legal charges. When the examiner tells you to give the reasons to prevent hostile takeover, the question becomes easy because there are many, and maybe the examiner will only tell you to explain 5. The only challenge comes when the examiner tells you explain what is Parkman's defense, explain what is golden parachute. That means you have to read those points and make sure that you understand well. Good. We are moving on well. The remaining part, yes. Let me go to the role of rigor and financial due diligence. When it comes to the due diligence, we say that there is the rigor. Each party should look at the regulatory compliance of the other party. That is rigor. Are you registered? Have you paid all the taxes? Have you paid all the licenses? Are you transacting legally? Are your intellectual properties registered? Like that. Legal due diligence. Financial due diligence is examining the financial records. How is the performance? Is there creative accounting? Is the tax that you pay a reflection of what is presented in the books? Then there is the overall importance. When we acquire, are we going to get the value? Is our value going to increase? Are there risks that will go down? That is the issue to do with the due diligence. The other thing that we need to understand is management buyout. The management buyout, this happens whether the management team of a company come up with a strategy to take control of a company from the owners. This happens when the management has a big control in the business and the shareholders, maybe they are not very much committed. Remember, we talked about the conflict between the management and the shareholders. The management can overturn tables. They can overturn tables. They can make it difficult. And like if the management said one day, we are going to resign all of us, and the shareholders don't have the knowledge on how to manage the company, then the shareholders say, oh, now what do you want? Let us then sell off this company. And the management have made an arrangement to buy it. The shareholder will be like, if you guys resign, we will lose the company. If we sell it, we'll be left with something. You see, those are the things that come in the management buyout. They try to buy out the company. Some other time is that they can convince the shareholder of the risk, and the shareholder feel like we don't want to undertake that risk. So we got all that, the attraction, management intimate knowledge of the business, potential for greater control, risk, high risk of debt, potential for management to overpay, conflict of interest, and the reliance on specific management team. That specific management team, they can manipulate, they can twist the shareholders. The source of finance for the MBO, mostly a combination of debt and equity. The management can raise capital and they acquire the company. The other one is management buy-ins. A transaction where an external management team, not currently running the company, acquire or control the stake in the company. Remember MBO, our existing management, they will acquire the company. And a buy-in, people who have worked in the company, they will reorganize themselves to come and acquire the company. So advantage, they bring fresh perspective, new skill, and potential or more objective. Disadvantage is lack of in-depth knowledge of the company. Those people who come from out, they may lack much knowledge about the company. The other thing is what we call the going private. We have seen cases where listed companies go private. a publicly listed company is acquired by an individual and it become a private company. So this is called delisting in the Securities Exchange. The examiner will tell you define delisting, define going private. It is a company that is listed in the Securities Exchange. They sell the shares to a private investor. It ceases to become a public company and become a private company. So why do we do delisting? Number one, reduce the regulatory cost. Sometimes the cost of compliance for listing is very high. Number two, freedom from short-term market pressure. Sometimes companies that are listed, you could have a bank. The competition from the big banks that are listed and the expectation is too high that you feel, no, we don't want this pressure anymore. Let us delist and go to a lower level where we are not required to do a lot of reporting, a lot of compliance. The other one is the greater flexibility. In private companies, it is very easy to make a decision. But in public company, there is a lot of bureaucracy and a lot of processes. So a company may feel that it is becoming too much in decision making. Let us delist. Then elimination of the agency costs. We know that in the publicly listed company, it is a requirement for audit. It is a requirement for other compliances. So to eliminate those mandatory auditing, to eliminate those mandatory costs, a company can delist. Then privacy. We know that a listed company is supposed to publish everything. For private company, they are not. So it makes privacy. Then simplification of the ownership structure. This means that in a private company, we have fewer owners and the decision making is easy. So you eliminate the issue of so many shareholders. And as we clear, the last thing that I want us to look at is argument against delisting. Why should we not go for delisting? One, loss of access to public capital market. Remember, listed company, it is very easy to trade its shares. Liquidity issues for the shareholders. Shareholders in a private company cannot sell the shares with ease, but in public company, you wake up and sell your shares at any time. The other one is loss of the public profile. A big company that is listed in the market feel that they have that public profile. So when you delist, there is that element of the publicity that you lose. The other one is increased reliance to debt. Sometimes listed companies have access to finances. They can issue shares without borrowing. But a company that is not listed, if they want money, they can only borrow. Then potential for underpricing. We know that the forces of demand and supply in the market will influence the right pricing of the shares. For a private company, the price of the shares is determined internally. The forces of demand and supply may be lost. So I have tried to move fast at that last part because I wanted us to finish the theory part. And I think we've moved well. Someone said, check your microphone. Sorry, I never saw that. Oh, so many minutes ago, about 20. I hope you are sorted on, or it is something, or it was not a reference to me. Maybe someone, we are not hearing you. Oh, I said when you cannot hear, or if there is something that need to be addressed immediately, please just unmute and speak. Oh, yeah, someone was telling them to check their mic. I think I was visible. A share exchange, my question is the two what? Business has different share. nominal value, and when they come together, what could be the new share value? That's a good question, although I'll be going back to that. When two companies come together, they go to the registrar of companies. They change the par value of the shares, then the market value of the shares. If they are listed, is left to the forces of demand and supply, but at the time of valuation, they agree on what is the value of the share. That is where we determine whether there is dilution or non-dilution. We look at that from the computation point, the computation part. So that is a good question, but I will revisit it again. But when it comes to the merger and acquisition, the company will go back to the registrar of companies and they will register the shares again. Is there any situation that any entity need? Okay. I think those are questions that we had on. So I want to thank you people for the 2 days that we have been together. It was a good start. We are meeting again next week on Thursday, and I can tell you, if you are going to move like that, we will get it. We will make it. We will solve more questions. I will always make sure that we solve more questions, because the end game is that you will sit an exam. Thank you so much. Have a great evening. Pass my greetings to your people. I appreciate your time. Thank you so much.
Rona, wewe Rona,
baragenda kuri bagana bo wati twese turabukuru apfa kumva ko gatangaza apfa kumva babiri romantique buzabe kandi ari n'ikigero kubera ko nakabutose ngera njya mbona statizeri narebye ndamwohereza noza invitation gusa ntabwo yagize akora ubundi nayo muhaye nzi neza ko atazi mba mperuka muri rusizi yigisha nimba ari haki noneho umugabo we gukora ibutare cyangwa namberukaga umugabo yigisha icyazo baba umusozi hepfo yirangira kwimuka rero baje kwimuka kumva ngo kabudosi yagiye ibutare ngo niyo niba ari yigisha baje bareba abana bo kwishyura gusa bakora Bueno, pero no hay un grupo de muchachos que van a asumir buscar. Ay, como la unión por la que por Facebook, algo como una muchacha que le dice Santiago, estaba a muchacha ya sabes. Eso es ya shati mugabo.
Ah, we.
Hapo ni chiyo. Niba bashatse abakuru umusatsi abafite abavuka mu by'Urwanda bose b'abakobwa uwa kane ajya gushaka batatu bose b'abakobwa aho n'ikirenze nawe yatwaye igikombe umwana we yangarutse namukeneye kugira ngo umwana ntabwo ari we umwana w'uwo
arimo aratura undi mwana aramukurikiza undi azakora uyu nguyu nabonye azamutse n'igihagararo
urabona atari kwirinda
impamvu abantu barahangayitse buri gihe urarira rero byose ntabwo turatimuriza ayo marira ntiyatuma mbese aricara akarya ibyo akarya akayobora
turi kumwe agenda amutabika akabyara n'ubutuje nyine amubere turagira mu rugo ntigira umutima agakira atari ariko nacyo cyakora yari yambaye ugati mu kanya turi kuza ubuzima bwe ni ubwonko twese abantu bari kwigira inama
nose telefone asumuza nabonye yazose bidede natasha
washatse we bituma yabonye umugabo aravugana ku mateka maturamuzi haje kujya mu gisirikare urugasa abirukanaga na ba federa urumuna we rero bitaga ruguru yigaga inyuma
Ngarije pirimeri batumanye bari kurangiza za turokome
yari mukuru cyane yari mukuru tumanye
Tradisi nawe we yari yarahangayitse rero
bityo barabona ko ari nyanzage
nurabaye nabi n'amateka yawe
yuko bitwaraga nabi cyane byari bigorana kuza ku mugabo aho bamufanye mu gisirikare rero kugana nawe yitwaga gasateri
nabonye telefone na sedede zagiye gushyingira
n'uwahe
none aho muzi
nyine umuhungu
umuhungu ntawe muzi nabonye isa nayo
yego twiganye ageze abisambaza kuzana ku ishuri tutazegera kugenda niba zibahuye ku ishuri n'isambaza
nawe barumuna be bose barose
murumuna we ntiyageye uganda
safi
barerose hakoze ko yari arashaka yagiye muri cya gipindi cy'abanyeshuri bajyaga uganda ageze ahitamo nawe sejo wa ntawe waretse kwiyibwa urushe dadi
ndetse abandi bakiriye hehe gihera
jona
ikiragenda ifungure fanta
Como assar? É o nome para falar.
reba batanga
jona
Chona. Wao kuna kutarudi. Kuna kutarudi. Kuna kutarudi. Neno. Mama